Hello everyone, and welcome back to the channel. So you're interested in investing in real estate, but you're stuck at this huge crossroads. Are you going to take the hands-off path of REITs, or take the path of being a landlord with actual rental properties? It's a huge decision, and frankly, there is no one-size-fits-all. The right choice for you is really about a few key things: how much time you've got, how much money you're starting with, how much risk you can take. And this is a huge one: your tax situation. We're going to break down this entire strategic decision model today so that you can take away from here exactly which direction is the right direction for your goals. Let's get started. So, in the middle of all this controversy, there's a simple trade-off. On the one hand, you've got REITs. Think of them as liquid, passive income machines. They're legally bound to pass on most of their profits, so they're perfect. If you can be a passive investor that just gets dividends and gains instant diversification across a group of properties. And then on the other hand, you have direct rental property ownership. That's just the opposite. It's active, it's illiquid, and it's a levered wager on a single piece of property. But what you get back is incredible control, especially with regards to leveraging with debt to amplify your returns. And you get access to some of the most terrible tax avoidance strategies on earth. This is usually the plaything of long-term players, particularly if you're in a high tax bracket. Now let's demystify REITs quickly. They're not created equal. Most of the ones you'll hear discussed are equity REITs. These are firms that own and manage actual income-generating properties, such as apartment buildings, malls, or warehouses. They generate profits from receiving rent and from the properties rising in value over the long term. Then there are mortgage REITs. These guys don't own the buildings per se. They simply leverage them with mortgages and loans. They derive their income from interest on the loans, so they're extremely sensitive to interest rates. And finally, there are hybrid REITs that split the difference. The most critical thing to remember about all REITs is that rule I mentioned. They have to pay out at least 90% of their taxable income each year to shareholders. That's why they pay those good dividend yields, but also why they can't essentially hoard a lot of money to invest, which means they're more income vehicles. And here now is a very important distinction that people often forget. When we say REITs are liquid, what we really are talking about is publicly traded REITs. Those are the ones that you can sell and purchase on the stock exchange in minutes, just like you buy and sell a share of Apple or Google. It's an open price, and you can make your money over quickly. But there's another kind called non-traded REITs. These are registered with the SEC but aren't listed on an exchange. They are highly illiquid. You could be locking your money up for a decade or more. And the worst part? They often come with insane upfront fees, sometimes as high as 15% of your investment, which just cripples your capital efficiency from day one. And so, the great liquidity advantage of REITs only really applies to the ones that are listed. All right, now let's return to the get your hands dirty arena of direct rental property ownership, or DRPO. Your income here comes from 4 mighty sources, and many new investors only notice the first one. First, you've got cash flow. That's your net income after covering all your bills and the mortgage. Second, you've got appreciation, the good old-fashioned appreciation in the property's worth over time. Third, and this is a sneaky wealth builder, debt paydown. Every time your tenant pays rent, some of that goes towards paying down your mortgage principal, which builds your equity without you ever having to lift a finger. And fourth, the ultimate game changer: tax benefits. You get to take non-cash deductions, such as depreciation, and use them to hide your actual cash income from taxes. The catch? This is really an active investment. You're the boss. You're responsible for finding tenants, maintenance, emergencies, and staying up on the law. It's a business, not merely a passive investment. Now, let's talk about admission cost, because that is a significant differentiator. In the case of REITs, the admission is extremely low. You can begin with the price of one share, a few dollars in some cases. It's fractional ownership, and all of a sudden, real estate is accessible to almost everyone. With a direct rental property, the barrier's high. You're typically putting down 20% deposit plus closing fees. So for a $500,000 property, you need to come up with $100,000 just to get in the door. That is not only a high barrier, it also generates instant concentration risk. You're tying up huge sums of your capital in one investment. This in itself may be the largest mechanical difference between the two methods, and it's the problem of debt power. You can typically finance 80% of the asset's value with a direct rental property. You retain 100% of the rental income and 100% of the appreciation, but you only had to put in 20% of your own money. That's the power of leverage. It makes your payoffs larger. REITs, on the other hand, are much more risk-averse due to regulations, and due to the fact that they need to keep their institutional investors happy, they typically only leverage less than 40% of their real estate. This stabilizes them, but it also significantly limits their ability to leverage their returns the way you can on a rental property. Just remember, leverage is a two-edged sword. It increases your risks just as much as your gains. And speaking of leveraging in an active form, this has given rise to a popular strategy in the realm of rental properties called BRRRR. It stands for Buy, Rehabilitate, Rent, Refinance, and Repeat. Here's the plan. You buy an ugly, run-down house that nobody else will. You fix it up, you restore it, and improve its value. And then you rent it out at a premium market rent to a quality tenant. Since the upgraded property is now more valuable, you go back to the bank and refinance it, pulling out your original investment money. Then you use that money and you do it again to create your portfolio. These are the basic principles of house flipping. This is a way to build equity with your own sweat. And the kicker? REITs can't do this very well legally because of something that exists known as the dealer rule, which binds them to hold properties in their possession for much longer periods of time. So with all of that, which one actually does better then? Well, historically, if we look at the performance over the last 25 years, listed equity REITs have been excellent performers, returning on average around 10% per year. They actually outperformed large institutional private real estate funds by over 2 percentage points. On a risk-adjusted basis, using something called the Sharpe ratio, REITs also came out ahead. And now, keep in mind that these benchmarks tend to compare REITs to big, passively held institutional portfolios. They may not reflect the hyper-efficient returns a clever, active investor is able to produce, with high leverage and techniques such as BRRRR on a rental property. So while REITs have a great record, a talented active operator stands to blow those numbers out of the water. All right, and inflation? Is real estate a good hedge? The quick answer is yes, for both. REITs have a strong track record here. Their dividend growth has actually outrun CPI inflation in 18 of the last 20 years. As the prices rise, so do rents, and consequently, the values of the properties they own. But for direct rental properties, your mortgage actually hedges you. If you have a fixed-rate loan, your monthly payment is fixed. While inflation raises rents and the value of your property, your mortgage payment stays the same. This has the impact of lowering the real value of your debt, which turbocharges your building of equity in real terms. This is simple but significant. How much time do you want to commit? A REIT is completely passive. You buy the share, and a professional management team does all the rest, buying buildings, collecting rents, fixing toilets. You do nothing except collect the dividends. A direct rental property is an active business. If you're self-managing, the time involved can be a part-time or even full-time job. You make all the decisions, but you receive all the worry as well. You're the one on the 3 a.m. call about a burst pipe. And of course, all that management has costs. REITs also have asset management fees, generally pretty minimal at 0.5% to 3% of revenues. Remember, avoid those non-traded REITs with their 15% upfront fees. For a rental property, if you do have a manager, you're paying 8 to 12% of monthly rent, plus leasing fees and markups on repairs. And then, if you self-manage, you pay $0 direct charges, but you're paying in time. The idea is that the REIT fee structure is more scalable for huge amounts of capital. Okay, we've finally come to what, for the vast majority of discerning investors, is the deal maker: tax efficiency. All those raw return numbers we've been talking about up to this point, they can be completely erased by taxes. What an investment is taxed on can be the biggest single factor in determining your real take-home profit, especially if you're a high earner. And this is where direct rental property ownership really shines. The tax benefits are incredible. First of all, you get depreciation. This is a non-cash deduction where you can depreciate the cost of the building itself over 27.5 years. This can shield your real cash flow from taxes entirely. You're making on paper, but paying less than nothing for it. You can deduct all your operating expenses: insurance, utilities, mortgage interest, repairs, name it. If you're an active participant, you'll qualify for the QBI deduction, which lets you deduct 20% of your rental income. And the crown jewel, the 1031 exchange. This allows you to sell a property, invest the proceeds in a new one, and never pay capital gains taxes again. This is a deep wealth building tool that only exists in direct real estate. Now let's take a look at REIT taxation, and it's complicated. When you get your 1099 DIV form, the dividends are divided up in boxes. Most of it, in box 1A, is taxed as ordinary income. So it's taxed at your highest marginal tax rate, the same as your salary from employment. It doesn't get the good, lower qualified dividend rates. Some of it might be in box 2A as capital gains, which is better, taxed at the lower long-term rate. And some might be in box 3 as return of capital, which is not taxed now, but lowers your cost basis, so you're charged with a larger fee when you eventually sell. This clever tax drag is an ugly headwind, but there's a simple solution. Hold your REITs in a tax-favored account like an IRA or 401k, and all this complexity disappears. So let's encapsulate the risks. They're quite distinct. REIT risks are market-related. They're volatile, stock-correlated, interest rate sensitive, and you have no control. Rental property risks are operational. You're exposed to concentration risk, vacancy risk, bad tenants, and expensive repair bills. The property is illiquid. You can't sell it easily. But here's the key distinction. The operating risks of a rental property are largely under your control through your own knowledge and careful management. The market risks of a REIT, absolutely nothing you as a small investor can manage. So, then, who owns the rental property? Let's build our first investor archetype. This is the active operator. You are in the high tax bracket, so those depreciation shields are precious to you. You have high tolerance for leverage and don't mind a concentrated bet. You are willing to put time, 250 hours or more a year, into your business. And you are in it for the long haul, to use such tactics as the 1031 exchange. And if that sounds like you, the answer is simple. Direct rental property ownership is probably your best choice. Let's build the second archetype. This is the passive allocator. You want no time commitment, no operation hassle. You perhaps have limited initial capital. You need high liquidity, since you want to be able to access your money quickly. And you want instant diversification by asset class and geographies. If this is you, then the winner is clear. Publicly traded REITs, especially if you have them in a retirement account to eliminate the tax headache. But you don't have to choose between the two. Savvy investors use a hybrid strategy. You can use direct rental property as your focal point for leveraged expansion and enormous tax shelter. That's where you build serious wealth. And you can use REITs, which reside in your retirement funds, as a complement. That gives you liquidity, allows you to diversify into unique sectors like data centers or healthcare, and brings solidity to your overall portfolio. It's the best of both worlds. For high-tax actively managed investors, DRPO has superior after-tax results. The cost of doing business is the price you pay for leveraged, tax-sheltered compounding that is virtually impossible to match. For passive, liquidity-focused investors, REITs give you instant diversification, expert management, and the freedom to not have to concern yourself with tenants. They're ideal in tax-deferred accounts. And the single most decisive factor of all? Your marginal tax rate. Being a high-income investor, the tax advantages of owning directly are enormous. Otherwise, or if your time is worth more than anything else, then REITs are your pain-free, passive path to real estate. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.